Well, the threat of U.S. tariffs hangs over many parts of the Canadian economy, and one part that could be especially impacted is the rail sector. Joining us now to discuss is David Mao, Vice President, Director, and Portfolio Manager with TD Asset Management. David, welcome to the show. And of course, the big talk right now is on tariffs, which could be in place as early as February 1st. Tell us, how could this impact the Canadian rail sector?
Yeah, I mean, it could be quite impactful for the Canadian rail sector. So we're talking about CN Rail and CP Rail, or CP Kansas City Rail. When you look at the numbers, CP as a percentage of their total, freight that they move, about 40% of their volumes are cross-border. So between Canada, US, and Mexico. That number for CN is a little bit lower. It's about 32% of their freight volumes are cross-border. But as you can imagine, if we were to see a 25% tariff being implemented, say February 1st, Trump hasn't actually confirmed that yet, but he has used that as a potential date. I would expect that the amount of freight that's being moved would fall significantly, right? Like there's no way around it. The cost of imports into the U.S. would go up overnight by 25%, so that would have a very big effect on how much the U.S. is going to import from Canada. Now there are puts and takes. One of the things that Trump is trying to do is kind of bring that manufacturing base back to the U.S. So, if we actually do see that reshoring or nearshoring come back to the U.S., you would see business activity in the U.S. pick up. So that would be good for volumes of the rails, given both CP and CN have meaningful exposure to the U.S. market. The problem there is that there's definitely going to be a timing issue, right? Because tariffs, the impact of the tariffs would happen immediately, whereas the impact of nearshoring or onshoring, where you see more construction and manufacturing
That's
activity,
much more long-term.
Exactly. That would take, at a minimum, we're talking months to probably more likely years. So there'd be a significant mismatch in the timing of these volumes moving around.
Okay, and you talked about the volumes that CP and CN are bringing into the United States. Is CP Rail more at risk with its network, which extends into Mexico, compared to CN?
Yeah, so based on the numbers, you would definitely say that CP, with its larger exposure to Mexico, US, and Canada in terms of cross-border activity, would be more at risk, because Trump is not just talking about 25% tariffs on Canada, but also 25% tariffs on Mexico. From that perspective, CP would certainly be more at risk. The one observation that I'll make that I think is interesting is, if you look at the share price performance year to date of both CN and CP, CP today is up about 10% year to date. So we're just talking about January. CN's up about 5%. So both of these companies are actually outperforming the market by quite a bit. So that would tell you that investors they're not particularly concerned that the tariffs are going to have a huge impact, at least to the financial metrics of these rail companies. Doesn't mean that we're not going to see a major sell-off later when we get more certainty around the tariffs. But as of right now, year to date, the stocks are actually performing quite well.
Okay. Now this kind of leads me to my next question. Do you see this as having a prolonged impact on their earnings, the bottom line? And is there anything that these companies can do to shore up their businesses in a tariff scenario, if in fact we do see a tariff imposed on Canadian goods?
Yeah, I mean, to answer your last question first, there's probably not a ton that either CN or CP could do in terms of volumes. So once the tariffs come into place, there's not too much the individual companies can do themselves to drive higher volumes. Where they do have some flexibility is on the cost side. So when I look at the 2024 operating ratios for CN and CP, an operating ratio is just basically expenses over total revenues as expressed as a percentage. Right, so right now in 2024, it looks like the operating ratios are going to be somewhere around 62, 63%. That means as a percent of total revenues, expenses accounted for about 62 or 63% of that number. That number historically, at 62, 63%, it is a little bit on the high side. So I think in terms of kind of driving earnings per share growth, if the rails can kind of contain that, their expenses a little bit better, and right now in 2024, it looked like volume growth for these rail companies were somewhere between 2 and 4%. The projection for 2025 is kind of 4 to 6% mid-single digit. So if they can get that kind of mid-single digit volume growth, tariffs notwithstanding, and they can control the expenses a little bit, you could easily see 1 to 2% improvement in the operating ratio, which would drive, in my opinion, something close to double-digit earnings per share growth for 2025.
Okay, now you talk about expenses. Beyond the tariff threat, of course, what about the labor issues facing the rails? Of course, we've had strikes that impacted last year, and CN Rail seems to have just avoided another strike. So do you see this as a continued risk for this space going forward?
So no, that's a very good point, Anthony. So for the near term, no, because CN did sign a pretty big contract with their labor unions in December. And again, I think it was yesterday, they also signed a smaller contract with another labor union. And CP actually today also announced that they had come to an agreement, a multi-year agreement with their mechanics union. So at least for the near term, I'd say for the next kind of 2 to 3 years, the risk of major labor disputes are kind of off the table for now. So yeah, on the labor front, I think they're going to be okay, for a little while.
Okay. All right. And what about some of the potential or positive catalysts for this space? What could go right for the rails?
There's a lot of stuff that could go right and wrong. I mean, there's always a lot of puts and takes, but it looks like infrastructure spending both in Canada and the U.S. is positive. You have some with the Trump administration coming in. It looks like we're going to have some changes to environmental policies and energy policies. So you could see more activity in oil and gas, which is going to be positive. On the flip side, manufacturing hasn't been great recently, and I think for 2025 it's going to improve, but we don't know how much yet. We know that the auto sector is also kind of bit on the soft side, so that's also not great. But so when you put it all together, though, I do think that there's more positives than negatives. So the overall operating environment is, in my opinion, looking okay, pretty decent.